The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters. Thanks for being with us this week. And of course, this week is Tax Week with renowned tax expert Julia Hartman from Ban Tacs. Now, thanks for all of the questions that you've already sent to me. Of course, everyone who sends in a question will receive one of my books as a prize. And this week, it's How to Achieve Property Success, which will guide you through everything you need to know about property investing. To get your copy, email a question to me at pim@mypropertytv.com.au. Send it in a message on Facebook or pop it into a comment on any of my Facebook posts. And then watch at the end of the show to see how to get hold of your copy once we've answered that question. If you don't have a question, you can get that book or any other book that I've written as well, either via my website, destiny.com.au, or at most good bookstores. Now, for my guest tonight, Julia Hartman is a chartered accountant and also founder of Ban Tacs Accountants. They have 13 offices Australia-wide. Julia's written lots of books herself on the subject of property and tax, and in my opinion, she's indeed a guru in that area. Tonight, we're going to look at a number of things, including how the tax office assesses whether you're in the business of property investing and what you should know tax-wise before signing a contract. Let's welcome Julia to the show tonight. Julia, how are you going?
Hello, Margaret. Thanks for having me. Yeah, going fine up in northern Queensland at our Mackay office at the moment.
Yeah, all right. I don't want to hear about your weather and your COVID-free living right now. I think we're going into week 6 of lockdown here, or we're well into week 6 of lockdown. And the weather's actually divine here at the moment, yet we're inside, really not able to enjoy it much apart from a little walk every day, which of course we're taking advantage of that. Looks like we're going to be in here for some time yet. So no better time to talk about tax than when you're in lockdown, if you ask me. And what I want to start with, Julia, is to talk about the tax office's definition of when you are in the property investing business. So I want to start by, first of all, having you explain what the tax office's motivation is there in having that distinction between just being a property investor or being in the property investing business.
Well, there's so many concessions for being treated as a business, so there's got to be a line in the sand that they draw so that the passive investor doesn't get all those concessions. Like there's tax offsets, there's extra CGT discounts, there's those things that you just recently can't claim, like travelling to your rental property and depreciating second-hand equipment when you buy an established house. If you're in business, you can do those things.
Right. Now, it was always my understanding from years gone by that nobody wanted to ever reach that point where the tax office says you are in the business of being a property investor. So being in the business of being a property investor rather than just being a property investor. So let's go through the pros and cons of it. You're now saying that there's a couple of pros. For example, at the moment, as a property investor, if you buy a property, you can't claim the fixtures and fittings inside that property as a depreciation deduction because you're not the first owner of them, unless you put something in after you bought it. But are you now saying that as a property investing business, you can?
Yes, if you're considered a business, there's a carve-out in that clause that allows you to have a write-off of the plant and equipment as depreciation. And at the moment, because you're in business, you'd actually get qualified for immediate write-off of the whole cost. So you can imagine buying a second-hand property, getting a quantity surveyor report. Unfortunately, you know how I feel about them.
Okay.
But getting a quantity surveyor report coming up with $20,000 worth of plant and equipment and going, well, that's an immediate deduction for me.
Look, it leads me to the next question, because, you know, whenever I talk to you, Julia, I think of 100,000 things, and generally they all apply to me as a property investor, but hopefully also apply to most of the people who are watching the show. If I already own a number of properties, as do I, and many, many other people out there who watch the show, and I decide that I'm going to go into the business of property investing, can I cover just the next property that I buy with that, or do I have to bring all the properties I already own into that business?
Well, they are. Let's go back to how you said how we want to avoid being in business. That's not generally if you're going to do a little bit of property development or build new homes, because you want to still get your 50% capital gains tax discount. You see, that's why people don't want to be considered in business. So the main thing is to make sure that the property itself is an asset you're using in your business to produce income, not part of your trading stock that you're actually building houses to sell, so that you don't have that worry.
All right, so let's assume then, let's leave out the whole developing side of things, because that has more limited application. Most of the people watch this show to find out just a bit more about just straight up property investing. Would you say on balance then that being in the business of being a property investor is better for your bottom line than just being a property investor with a number of properties?
Yes, and in answer to your question before, you can't say, well, these ones are and these ones aren't. You
have to bring them all in. You would just suddenly bring them all in and bang, I'm in the property investing business and this is my business. So I guess for someone, if someone technically had a lot of properties and they were thinking of retiring, could they then the following year after they retired go, right, well, now I'm in the business of property investing because I've retired and I've gone into that instead, and these are all the assets of that business?
Yeah, well, that's probably a good time when they could say that, because they're more actively involved. So if we can just take some time to look at the definition of when you cross over to be in business.
Yes.
So we've got a couple of cases where the case YPFD. See, I didn't know that off the top of my head, Margaret. It was letters, not numbers.
It's an easy one, Julia. It's not like that's a hard one. I mean, you remember 15 numbers in a row, and you can't remember 4 letters. What?
No, that's it, I'm afraid. But anyway, in this case, it was long-term rentals. She had 9 of them. And she argued that, and owned them with her husband, she argued that she was in business even though she had a property manager. And the things that got her over the line was that there was a lot of money tied up in all these properties. She proactively managed them even though she had a property manager, because she convinced the court that the property manager was pretty useless and she had to do a lot of stuff. Yeah, I don't think that's hard, is it? So, that she got over the line that she was in the business. So that meant, in her case, that she could be considered a partnership with her husband and distribute the profit of the business on a different ratio other than what was on the title.
Okay. Look, it opens up a whole lot of questions for me, and no doubt I think about my own portfolio, which, as you know, is very, very large, and I'd have no trouble convincing a court of law that I am actually in the business of property investing, because despite the fact that I do also have property managers everywhere, there's a considerable amount of work in just keeping the books for a property portfolio the size of mine. So collecting the rents, I mean, I don't physically collect them, but getting them into the bank accounts, acquitting them, paying, all the different providers outside of a property manager, all the repairs and maintenance and all that. There is so much work in that I actually don't even do my own work on that. My PA does it for me, and I'm dreading the day that she retires, because I just am not going to have the time to take it over myself. So I think it's pretty easy to be able to justify, if you do have a big portfolio, that you're in the business of property investing. If you were to suddenly do, as I said, and for anyone out there watching the show who already has a number of properties and are considering trying to go for this, does it affect you if all the current loans that you have are all in your personal names?
No, because you can be a sole trader in business. And the reason I think it's relevant to when you retire is because of this idea that you've got to be proactively involved in it. So when you retire, you've got the time to do more of the stuff yourself. And she, even though YPFD, she had a job and she still showed that she had spent a lot of time on those properties.
So just to confirm, you can't suddenly decide, well, I bought a property, now I'm in the property investing business. There's really a number, isn't there? And you'd say about 9 would be the number, 9 and considerable effort around those 9, and you'd probably qualify.
If they're only long-term rentals. On the other hand, if they're short-term rentals where there's a lot more work involved, the number gets lower because you're so much more business-like. And there's a case called G10. No problem with that. It's got a number in it. Anyway, they own 6 units, all in the one block on the one title. So technically only one property, one title. But it was holiday units, and they were, like they said, it was a 7-day-a-week job. They didn't prepare meals, but they were showing people around, cleaning, maintaining the area, taking the bookings, all that. There was furniture provided, linen, crockery. So they were considered to be in business too, but that 6 properties meant they were in business. On the other hand, there's private rulings which sort of bring it down to if it's 3 or less, probably not in business. It's a common law issue, so it's not like it's hard and fast in legislation.
So apart from the fact that if you are in the business, you can claim things like travel to the properties and you can claim that depreciation on the second-hand chattels. Apart from that, are there any other advantages of being in the property investing business over being a property investor?
Yeah, there's a couple of good ones in that you can decide how assuming it's positively geared, you could decide how to distribute the profits. So you could give that to the low income earner, even though the properties are owned 50-50. And that small business tax offset, which is still around until 30th of June 2022, and that's going to be 16% this year, up to $1,000. So if you're in the 19 cents in the dollar tax bracket, for example, you only pay 3% tax on the profit from your rental property, but the up to $1,000 in tax credits.
Okay, so good advantage.
And that's per owner.
Right.
Sorry, that's per owner, so that's very valuable. It's double that amount, really, in most cases. So you've got that travel. You're not going to get your holding costs during construction, I'm afraid. There's no way around that one. But what I consider also exciting is the small business concessions. So you get 50% discount when you sell. Well, there's another 50% discount if the asset you're selling is an active asset used in your business. And another, that leaves you only 25% of the gain being taxable. And there are rollover relief and retirement exemptions that could make that not taxable too. But this is where we get tighter in the legislation rather than looking at the common law definition. And the small business active asset concessions specifically exclude rental income. So properties used for rental income. So you're not going to get it in your case, Margaret, where you've got your long-term rental properties, but I believe you should get it if you've got your short-term ones, your Airbnb and that, because there's an example in the legislation, which, am I going to bore you if I read it to you? It's not very long.
No, go ahead.
A company uses a house purely as an investment property and rents it out. The house is not an active asset because the company is not using the house in the course of carrying on a business. If, on the other hand, the company ran the house as a guest house, the house would be an active asset because the company would be using it to carry on a business and not to derive rent.
Right, okay, that's very clear.
Yeah.
All right, well, look, it looks like there's a lot of advantages then to being able to have it as a business. Is there disadvantages, though, that would make people maybe just on the cusp there decide to stay as a property investor?
They'd have to be worried about GST more than anything. If they're building new properties, they've got to worry that that just adds to it. So they'd have to, if they build a new property, they might be building it to hold as a rental, but they need to hold it as a rental for 5 years before that doesn't qualify for GST. But no, it would be unusual, because all you're doing is arguing is just like the warehouse in a normal business. It's not what I'm selling. It's not, I still get all those discounts. If I was registered for GST, I would have to charge GST when I sold that property, if it was the first sale of the property, or if I cut off the backyard and sold. But are you registered for GST? To register for GST, your turnover, that's not sale of an active asset, but your turnover, which is your rent income, has to be more than $75,000. And domestic rents are specifically excluded from that turnover calculation. So you'd have to have commercial properties in there, other businesses in your business. It would be pretty hard to be caught out by GST, but it is definitely something you don't do without consulting your accountant to your particular circumstances.
Absolutely. Yeah. Good advice. All right, look, let's go now to contracts. And I know that there were some things you wanted to talk to us about contracts, but you wanted to start with a scary story about a chiropractor.
Well, yeah, the person that came to me, which their conveyancing solicitor fortunately sent them to me, but it was too late, bought a house off a chiropractor. So they went to an auction, and they were the only one bidding. Everyone else stood back, and they won the bid, and they signed the contract, because all real estate contracts are the same, aren't they? That's what they told me. Anyway, inside that contract was a going concern clause, and the conveyancing solicitor picked up on it, but they'd already signed the contract. So there was nothing the solicitor could do, but they sent them along to me to make sure there was nothing. And basically, because they'd signed a contract with a going concern clause in it, they had to pay 10% over and above what they paid for the property to the ATO in notional GST. So that's was $50,000 in their case.
Wow, yeah, that is definitely a trap that we would all like to avoid. Okay, what about some other things? I know you sent me through this nice list, which are the key areas that people should be very careful of when it comes to tax and signing contracts. Let's start with the first one.
That's whether the price includes GST or not. There have been many cases of big arguments in the court, so it's not just a person in ignorance mistake they make. Big organisations have done this and had to fight it in the court, that it wasn't clear in the contract whether the price they'd agreed upon included a GST or not. So it needs to be very carefully looked at. It's not necessarily clear when they write the price in the contract. There might be GST clauses further down that almost contradict what's written in the contract. It needs to be examined before you sign it. I won't nag too much on that, because at the end I'm going to, how you do it, really stick it in. But anyway.
Well, we will wait for the big nag to come.
Yes.
But for now, I know that it is important that if you're buying a house to live in, that you get that house with vacant possession. But a lot of people don't understand why that is.
Yeah, well, if you've used the property to produce income before you move into it, then you only get your main residence exemption on the property from that date that you move in, which means you've got a capital gains tax nightmare sitting there all the time you own that property. You have to calculate the capital gain and apportion it, and the tax won't be much. It's the record keeping that'll be a nightmare. So you need vacant possession to avoid that whole problem, because being used to produce income, it simply happens because you've got a sitting tenant.
Yeah. Look, I know one of the other issues that people don't think about before they actually sign a contract, particularly when it's an auction, is what name goes on that contract if it's going to be an investment for you. Because we've had certainly plenty of people who come to us where they have bought a property, they haven't thought it through, and they've ended up with the wrong name on the contract in terms of the best way to go about your tax. Can you just explain that a little bit further?
Well, yeah, it's something that you've got to talk through with your accountant. And some states, if you go and change it later, they double stamp you. Or the seller just might not let you change it. You're going cap in hand. So this is one of the things that I say push you over the line to say just don't step back before you do anything and get advice, because you can get this information sorted out too at the same time.
And I think the issue with the names is when it comes to tax deductions, then if there are two people in the transaction, a husband and wife, or partners together, or girlfriends or boyfriends, or whoever is coming into that transaction, everybody has a different tax situation. And sometimes if you're sharing an asset, it is often better to go in one name rather than the other, or even think about the tenancy arrangements so you can apportion ownership.
Yes, or a trust, or even, dare I say it, Margaret, super fund.
Okay.
Okay, all right. But it's something you need to look at, not only the tax brackets, but where the property is going in the long term. Is it negatively geared? Is it going to stay that way for very long?
Yeah, lots and lots of questions to ask. Definitely ownership is one of those big traps that a lot of people definitely get caught in. Now, we are running out of time, but I know that you just want to tell us one thing about those sunset clauses in off the plan purchases.
Yes. Well, it's happening quite a bit at the moment, apparently, where you see, and it's a clause in a contract that I suppose protects the purchaser, that if the developer takes a couple of years to produce the building, you can get out of the contract, you can get your deposit back. So of course, when property prices are booming, it's in the developer's interest to take time, and they get the property back, they get all the capital gain, and you've got your deposit back, but your market's moved $100,000.
And what about the specs? Because I know that I've seen contracts where there are certain specs on the property, but if you go past that sunset clause, it's almost like a new contract again, and the specs can change.
Yeah, well, I think even before the sunset clause, the specs can change, because there's usually something in the contract that says or equivalent, as the development goes on. Also, we were going to put marble bench tops in, but it didn't work for this. We couldn't get them up the stairs, so we put in particle board. They usually have an option of changing those sorts of things. You need advice from your solicitor on that.
Yeah, a lot of people don't realise that, and there's often just even like a 10% clause with regard to even floor space. I've seen apartments delivered to people that are up to 10% smaller in size, and apparently it's quite legal within the contract for that to happen.
Yeah.
Well, Julia, we have to go off for a quick break, but while we're gone, the viewers can send those questions, be they tax related or otherwise, that they have about property investing straight to me at pam@mypropertytv.com.au, or of course via a DM in Facebook, and I'll make sure that at some time in future shows, if not tonight, that we answer that for you. For now though, stay with us. We are off for a short break, and we will see you when we come back.
Setting and forgetting your property portfolio can be just as bad as never getting started at all. If you're not staying on top of interest rates, loan structures, tax deductions and current rent returns, there's a good chance that your portfolio is underperforming and you're losing money. Whether you have a large property portfolio or you're just starting out, monitoring your properties is just as important as buying them in the first place. Destiny's finance and portfolio monitoring service will not only oversee your rentals to ensure they're always achieving the best possible return, it will identify when you're ready to invest again and ensure that you always have the best and most cost-effective loan products available. And with more than 25 years of experience and billions of dollars in finance applications completed, you can be sure you're in safe hands with the experts in the business, Destiny.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.
Thanks for staying with us. You're watching Property Investing Matters on My Property TV, and joining me and talking about those tricky little tax issues is Julia Hartman from Ban Tacs Accountants. Now remember, you can join us with your question, and if we answer it, you'll receive a copy of my book, and this week it's How to Achieve Property Success. Julia, we have a whole bunch of viewer questions this week, and I wonder if you would like to help me answer them.
Certainly, Margaret.
Let's go to the first one, and it comes from Jan and David. And Jan and David say, "Hi Margaret, I'm wondering about your views on exit plan scenarios leading to retirement. We have 7 properties and we're starting to think how we will continue to carry these into retirement planning. Do you ever think it is wise to sell some high-performing capital gain properties to use the equity to own the others outright? While our properties are all neutral, we fear ongoing costs when we no longer can earn an income and are relying on self-managed funds." Well, Julia, this is almost a classic case that might even qualify to switch over to being in the property investing business.
Yeah, I'd be out there making a few of them Airbnb or buying another 2 properties and getting all those lovely small business capital gains tax concessions when they sell. But having that aside, I'd also suggest that maybe they should sell the home that they're living in, because they get all the sale proceeds of that capital gains tax free, and move into one of the rental properties if it's suitable, and maybe use the sale proceeds of their own home to retire any debt that they need to.
Yeah, that's a great plan, and certainly if any of those properties are anywhere near where you want to live and maybe can be renovated if they're not already done so, that way you're reaping the benefits of a capital gains tax-free money from the house that you're moving out of, but using it to reduce the debts on the properties that remain in your portfolio. So a couple of options there, I think, Jan and David. Look at those small business concessions that you might get by transferring everything over into a business of your own. Julia's idea of maybe Airbnb, a couple of them, is a great one. I know that my Airbnb properties are very, very profitable for me, and I'd love all of my properties to be Airbnb, except that it does require more work, which you'll have when you retire. I think the thing from my perspective is it might seem easy enough to just identify those high capital growth properties, sell them down to reduce the debt, and then keep the remaining ones. But to me, you've got to really consider what it is you need the most. If you've got a significant amount of money already in your self-managed super fund and you don't really need a lot more capital assets, but cash flow is really important to you, that's a strategy that could work, and you might choose those with the highest cash flow to remain. And that way sell down the ones that, okay, they're growing pretty well, but the rental yield on them is very low. Often rental yields in some high capital growth areas can be low, 2 and 3%. And if interest rates go up, that can be a problem. I know certainly that's what I'm doing with my portfolio, looking at how I can improve cash flow. I don't need any more equity or any more growth in my capital assets. I wouldn't turn it away, but I don't need it. So cash flow becomes important. But if on the other hand, you've got some good cash flow coming from your other assets and your super fund, then it could be that increasing your bottom line wealth in terms of capital growth is important to you. So this one really does need a really good discussion with your accountant so you can really identify what your bottom line asset base is and what your bottom line cash flow is. So you know if you are going to reduce some debt, which properties to let go of and which properties to hang on to. Let's go to our next question from Andrea. And Andrea says, hi, Margaret. My 5-year interest-only loan period will expire in December 2021 for 2 loans and another a short time after. After having done your course in person in 2015, I'm happy to have been able to ride this property wave the last 5 years. I'd like to refinance with another interest-only loan, but I'm just not sure, 1, if it's even possible, 2, how to succeed in doing it. It would be a shame to have to sell the properties, and I'm not sure I can afford P&I on my loans. Julia, for a while there, interest-only loans were the thing, and then banks stopped giving them. But I'm pretty sure that a lot of banks are starting to ease up a little again and start to provide those interest-only loans.
Well, that would be your area of expertise, Margaret, but my experience is they still want a higher 1% higher interest rate. And if you do the numbers over a 30-year loan to go P&I, the repayments aren't that much different, but by the end of the 30 years, you've paid off the whole debt. I've done the numbers with a 1% difference in interest rates. That could be a third, reduce your interest by a third. That's a lot of money towards capital repayments.
Look, I'm glad that you brought that up, Julia, because that's exactly the strategy that I've undertaken myself when a lot of my interest-only loans were coming up for maturity. I took the advantage of being able to lock in some really good low rates, and some of them were considerably less than or considerably more than 1% differential. You know, I'd gone from being on an interest-only rate, and it's very difficult to negotiate an interest-only rate, to locking in on some fixed rates that are in the high ones, as opposed to the 4.5 that I was paying on the interest only. And even those ones that I locked in at the high 2s, I still found that there wasn't a lot of difference overall across the whole portfolio in my overall yearly repayments. And Julia, I was actually saving something like $120,000 a year in interest repayments by doing that, which meant that $120,000 was actually going into the whole portfolio and starting to pay it down. And the only regret that I had was that I didn't look at it more closely and think of it earlier.
Okay.
So what do you think of that?
Yeah, fortunately your followers will not have that regret.
Yes. So absolutely, Andrea, don't write off the P&I loan as being impossible for now. It's likely you might be able to pick up a really good low rate from someone where your repayments are very similar to what you're paying interest only this time you'll actually be paying principal and interest, and it might just work out very well for you. Let's look at our next question from Philip. And Philip says, hello, I've refinanced my investment properties with another bank who have paid me on settlement $2,500 per property as a new customer for signing up. The only condition was the LVR needed to be at least 2080. Is this taxable income? My motivation for refinancing was to secure the lower variable interest rate, not the payment. Also, there are no other fees which I could offset this with. Julia, when I read this, I thought about the 30-odd properties I have in my portfolio and thought I could pay off a whole loan with the $2,500 per property that I could get by refinancing.
Yeah, it's. I think Westpac was doing it, so yeah, it's good stuff. But this is complicated. So as to whether it's taxable, so it's excellent that we've been discussing whether you're in business or not, because if you're in business, remember I've got those 9 properties, so it won't work for you, Margaret. You're considered to have got an incentive from the bank, and it is income to you. To anyone that's in the business of rental properties, it would be considered taxable income. When it comes to people that are still called investors, still considered investors, you have to look at what is it really for? Is it really, look at the wording. If it really is a rebate of borrowing expenses or a rebate of interest you're going to pay in the future, then it's a recoupment. And while the $2,500 might be taxable income, you won't get a deduction for the thing that you recouped because you didn't really end up paying it. But if you can get it that it's just purely a gift from the bank and you're just an investor, you may get away with it not being taxable. There's support for that, but the ATO have not got any clear guidance on it.
Okay then. Well, there you go. A good explanation there. Let's go on to our next question. No name on this one, that came in from our Facebook page, and it says, "Hi Margaret, I just wanted to ask about how banks work out your serviceability. I've got a substantial property portfolio and I've been told that I'm almost at my cap of servicing, at least from the big four banks. Since my income isn't likely to increase, if I were to pay down some of my properties, would the banks look at me more favourably if I wanted to borrow again?" Julia, I know accountants are often asked to help out with providing income figures to the banks for people who are trying to service loans. What are the biggies that you see there?
Oh, okay. Well, I thought we were really talking about what the bank's terms are, so I thought you'd have a field day with this, Margaret.
Well, I will, but I just thought I'd give you the option to jump in first.
Oh, I see. Yeah, there was something I wanted to say about that. What I've been doing a lot lately, Margaret, is everyone that comes into my office has got a property. We get on SQM research and look at the vacancy rate and the market rent, and suddenly they walk out deciding they're going to put their rent up $50 a week on their property. So if she's got a substantial portfolio, she needs to evaluate her rent. If she can put each property up, its rent's $50 a week, that would help her serviceability, wouldn't it?
Absolutely. And you've got a good point there, because I often find that when I go back and it's time for us to renew the leases on properties, very often the property manager hasn't advised me that I can get more. Many property managers will just either increase a little bit or just leave it where it is. Whereas if we do a rental assessment on it and often find out that we can take our rents up, even if it's only by a small amount, it will help. Serviceability is worked out in a number of ways. And remember that you have to qualify for a loan two ways. First of all, you need to be able to service the debt. Second of all, you need to have the equity to be able to get the loan. So you need to have at least 20% equity across the board to be able to get the loan that you need, or to be able to qualify for the lending level that you're after. Serviceability is where the banks consider everything that comes to you and everything that goes out from you. So everything that comes into you includes rent, but they don't take all of it. They just take 80%, sometimes only 60%, depending on where your property is located. Then there's your income. And if you earn a business income, some banks will add back some of those deductions that you might have had against that business income, like depreciation deductions. And some banks will also add back any depreciation deductions that you've had on properties as well, because your depreciation deductions technically reduce your taxable income, but it doesn't reduce the money that you get in your hand. Once they've considered all of the income from all sources, they then consider all of your expenses to all sources, and that includes every single thing that you spend on every single thing. And the banks have gotten very strict about that, and they even want to know your Foxtel subscription and everything else that you've got. They need to know about your other loans. If you've got credit cards with a limit that you're not using, then get rid of them, because they will consider that you've fully drawn the limit and you'll have the minimum repayment on that fully drawn limit every single month. If you've got interest-free cards, if you've got any other money anywhere, get rid of it, because they all go into being considered as payments that you have to make out. They will consider P&I repayments on all of your loans, even if your loans are interest only. And they will add a couple of percent to the interest rate, even if you're not paying it. And for some people with 4 and 5 loans, it effectively doubles the amount of money the bank thinks they're paying on their loans over what they're really paying on their loans. And for a lot of people, it impacts on their serviceability. I'm pleased to say that all banks are different, and some of the second-tier lenders are much more amenable to considering things differently. And often we've found that some people who don't qualify with the big four banks qualify for a considerable loan from one of the second-tier lenders. So it is important to talk to a good broker, one like Destiny, of course, and find out who will lend to you and how much they'll lend to you. You'll find a vast difference from lender to lender. Julia, this last question is yours, not mine, yours, because it's right up your alley. It comes from Frank. And Frank says, "Hi, Julia. My wife and I are joint borrowers on a loan for an investment property in my name only. The bank insisted on this arrangement. How does this then work for tax purposes, since technically I only own half the loan, but I get all of the income and pay all of the expenses, including all of the loan expenses?" Very typical scenario, Julia. How does this one work?
Well, generally the ATO let it slide, but I don't like people being that vulnerable. So what I prefer them to do is the spouse that doesn't own the property to enter into a loan agreement with the spouse that does own the property to charge them the same interest rate as what the bank's charging and all that. So it has no effect on the bottom line, but at least you can clearly see that the half that the ATO may argue belongs to the non-owner spouse has been on lent to the owner spouse. And those contracts, you can download them off the web. They don't have to be that flash. So just make sure you've got the documentation there. It's a no-brainer because there's no downside to it.
Absolutely. And look, it's fairly common that the bank does want a spouse to be a borrower. It's a good idea at the point of getting your loan, though, to investigate with the bank whether or not it's okay for your spouse just to be a guarantor instead. People often hate that word guarantor, and you wouldn't go guarantor for somebody else because the implications are that if they don't pay the loan, you are wholly responsible for repaying that loan. But if you're married to the person and you're sharing your assets, then being a guarantor for your husband or wife, in most cases, certainly isn't harming you in any way, except that if you then want to go ahead and get a loan in your own name somewhere else, your guarantor obligations are considered as an outgoing to you, even if you're not paying that loan, even if your spouse is paying that loan, the guarantor obligations on that loan will be considered when servicing you for another debt. So it's a good one just to think about on the way in so that you don't have those complications. But as Julia said, I know a lot of people who are just claiming the interest against the income earner's name, even though they don't own the whole loan. And I think, yes, the tax office lets it slide, but why not make it all nice and legal and clean and do as Julia says and download one of those loan agreements. Well, that is the end of the show for tonight. Don't worry, we are going to come back again in a week or two. And don't forget that you can watch past shows on the My Property TV website, or also on destinylive.com.au, where you can see everything that we've ever filmed for my entire life. Now, about 12 to 15 years of filming, it's all up there. It's all free to watch, and it's all catalogued. So if you've got a question on anything, go to destinylive.com.au, register for a free account, and then start looking through all of the educational material that we have there. Now, if we did answer your question tonight, send me an email to pam@mypropertytv.com.au. Make sure that you put book prize in the subject line. I will need your name and address so that we can send the book, and also which question you asked, and then we'll get that book straight out to you. Thanks for being here tonight, Julia.
Thanks for having me, Margaret. It's been great.
As usual, always a font of information, and it's great for my viewers to get all of those things nice and clear. You've been fabulous tonight, as you always are. You can find Julia at Ban Tacs, which is BANTACS, bantacs.com.au. I know, Julia, you have a wonderful little resource there where you can ask Julia a question for a nominal sum of money.
That's right. It's called Ask Ban Tacs.
Ask Ban Tacs, and Julia will be taking those questions. So she has a lot of helpful material on her property investors page. And as I said, she'll answer those questions for you as well. Remember, our new property match service is here. It's a great new way for you to get all the support that you need to buy a property, which is just right for you without the expensive price tag of some property advisors. Just drop me a line if you want to know more. Have a great week, and I will definitely see you back here very soon.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Setting and forgetting your property portfolio can be just as bad as never getting started at all. If you're not staying on top of interest rates, loan structures, tax deductions and current rent returns, there's a good chance that your portfolio is underperforming and you're losing money. Whether you have a large property portfolio or you're just starting out, monitoring your properties is just as important as buying them in the first place. Destiny's Finance and Portfolio Monitoring Service will not only oversee your rentals to ensure they're always achieving the best possible return, it will identify when you're ready to invest again and ensure that you always have the best and most cost-effective loan products available. And with more than 25 years of experience and billions of dollars in finance applications completed, you can be sure you're in safe hands with the experts in the business, Destiny.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.